Welcome to TradeTheMBI.com. This is John. This report is for the 19th of April and the continuation of the move as shakeout getting very close to being positive for the first time since back in end of January, beginning of February, before we had the collapse going back down. We're above the 50% line, and that attracted a lot more interest, even though it's declining 50%. If you went off of the older reading, which was 0875, we are literally right at it. So that could be a little bit of a consternation point. We're starting to see steel moving below cyan, shorts rising into this because they're recognizing they want to attack the key threshold. This flat line of the red DOC, not great because the reality is we should have broken above it. So we've really reached an inflection point. And every time you get that kind of situation, and then you start to see like this where the midterm buyers are fading off, it's a warning sign that, hey, you're reaching a point where we could see a traditional 50% pullback into the move. So you climb, and that wouldn't be inconsistent with what you would expect from this kind of setup. Time of the month is a little strange because there's just nothing really spectacular to take place at this particular point. We've had surprisingly good earnings, so that could be enough to offset it. And that's going to be the case throughout, simply because of the tax cuts. I think you saw massive readings from Amazon, blah, blah, blah. It's all going to be part of it. And, this is that ramp up of the economy and the side effects of it that it's really going to start to play out, vis-a-vis currency wars are going to start ramping up because you're going to be dealing with significant trade deficits back and forth amongst countries. It's going to impact, obviously, treasuries, and devaluation of the dollar is important, but it also causes problems, and that usually any devaluation in U.S. currency is always going to be recognized also in oil. So you could get some conflicting results out of oil, but we've known for a while that we've seen consumption increasing, and even the ability of U.S. to produce excesses in that. There's going to be that point where it starts to squeeze based on refinery, and that's going to drive price. We're not really looking at geopolitical concerns. You throw that into it and you could get a massive spike very quickly. But because a lot of the oil trade is converted back into euros and other things, in order to maintain spending power, oil prices will get driven up to accommodate for devaluation situations. So always worth noting. And gold moving back towards its high peak. So everything we're looking at is a growing economy. Things are improving. That doesn't mean that we aren't going to see the normal fluctuation. We're seeing a reduction now in the ATRs down to like 44 if you look at the beginning chart down at the bottom. I had it on the daily, and that's relevant from the standpoint of we still get a pretty decent news, though. Right in these last couple of days, we've started to see a little bit of a narrowing, even though we've had a big range. If I shrink this chart, you'll see that after we got the initial move, we've pretty much been in this little boxed range here with 2,700 roughly as the lower side of it, up to this 2718. So we'll see if that range holds. If it doesn't, then we can start to look at the fill of some positive extremes going all the way back over to here, which would be in a 2688 range, or even further, going back to the beginning of the move, 81. So worth bearing in mind. We've had a little bit of weakness as we reach the peak up here. Got progressively weaker as the afternoon went on yesterday. Overall, it was good until it got kind of choppy here, but every time the negative shakeout occurred. I don't know what program is this one is. Oh yeah, this is one of the function programs I'm working at from a intraday color chart standpoint. Not complete yet, but it's making some excellent progress. And we can see that we're, well, approaching new lows for this part of the session, but not overall lows from yesterday yet. We'll see if it spikes there. I think we had what was the low of that 2704, so we dropped all the way down and matched it, and they bought that back up. It's likely that we're going to continue and revisit that in the pre-market. So all in all, I think that the market is stable. I think that there's just plenty of trading ranges. I think that we've eased off from the initial breakout move that took place and brought us back up to this level. So I think it's worth being cautious as you go forward and stick to the readings and those zones, because now with the daily you have a very clear idea of expectations. Being above this declining 50% line usually wants to draw price towards the highs, but every day that goes by that high is going to be dropping, and so any dips in between here just make the propensity of getting there more difficult. But certainly at this point, below 2685 is definitely bearish in the short term, because that would be below the 50% adjustment range here. If you're playing it tighter, you could use 50% from slightly before, which is at the 0875, and play it accordingly. So that is the basics of it. As always, trade well, and I'll put up charts in between doing my program. It's been kind of quiet as I've been doing that, because it does require a lot of attention, but if something significant pops up, I will certainly be there to chime in. Trade well. We'll talk to you later.